Hello, this is Sheila, tutor for ACCA's Advanced Audit and Assurance at Elite International College. If you're sitting for this paper, you know that audit risk or risk of material misstatement questions appear in question 1. As part of the scenario, you might be told that the client has issued employee share options during the year. In this video, we would look at one question, OAK, and I will show you how to plan the answer and how to develop your answer to meet the examiner's requirements. But first, let's briefly revise IFRS 2. This standard covers rules on when a share-based payment expense should be recognized and how it should be measured. For recognition, the standard says, a share-based payment expense must be recognized when there is both a mutual agreement of the terms and a legally enforceable arrangement, meaning when it is legally binding. For measurement, there's a formula, and I use the acronym SOFT. This makes it really easy to remember the 4 elements in the calculation. So what does SOFT stand for? S is staff who are expected to remain in employment at vesting date. O stands for options given to staff. F is fair value of the share options at grant date. And T is time to vesting. And this could be 3, 4, 5 years depending on the terms of the agreement, and must be time apportioned if the options are granted sometime during the year. So what are all the possible risks when a company issues share options? On recognition, there's the risk that the plan is not recognized. On measurement, there is a risk that management have assumed all options will vest and those who have received the options will not resign before the vesting date. For O, there are usually no risks here because the options have already been granted at an earlier date. F, risk that the fair value has not been measured at grant date but measured at some other date. And T, the risk that the share-based payment has not been correctly timed apportioned, especially if the plan had been established sometime during the year. But there is also a related matter, deferred tax. IAS 12 states that share-based payment plans have deferred tax consequences, and this is because the expense is recognized in the financial statements in year 1, but the expense only becomes tax deductible in the year the options vest. As such, a deferred tax asset must be recognized in year 1. Therefore, in year 1, there's a risk that deferred tax consequences have been ignored. So now let's apply this knowledge to an exam question, OAK. The requirement of the question is to identify and explain principal audit risks. So the question says you're a manager responsible for the audit of OAK and you're about to commence planning for the year ending 31 December 2011. OAK established an equity-settled share-based payment plan for its executives on 1 January. 250 execs and senior managers have received 100 share options each, which vest in 3 years' time if the executive remains in employment at that date, and if OAK's share price increases by 10% per annum. No expense has been recognized this year as OAK's share price has fallen by 5% in the last 6 months, and so it is felt that the condition relating to share price will not be met this year. Now let's look at the question again to identify relevant risks for our answer. Did management recognize the plan? The question says no expense has been recognized. Next, should the plan be recognized? Yes, the question says that OAK has established an equity-settled share-based payment plan. So what are the risks? First, the risk that the plan has not been recognized. Then, even if management agree to recognize the expense, there's a risk that the measurement rules have been incorrectly applied. Then there's the risk that incorrect staff numbers have been included in the calculation, that they have included 250 instead of the number of staff expected to remain at vesting date. No risk in options granted because that was granted at an earlier date. Risk that fair value not calculated at the grant date. No risk in timing because the plan was established on 1 January, therefore time apportionment not necessary. And risk that deferred tax asset not recognized. So we can develop 4 risks for this point. So how would you write out your answer? Here's a guide, OMAR, O-M-A-R. Observation, start with that. This is a short story. No marks are given. Then go on to materiality of the financial statement item. Calculate this if the value has been given. Then you go on to accounting treatment and then to specify the risk. Here, under risk, there will be 2 sentences. The first one will relate the risk in the scenario to the accounting treatment, and the second sentence will be to illustrate the impact of the risk on the financial statements. OMAR is a guide to help you develop a well-balanced answer so that you can obtain the maximum marks awarded for your points. So let's apply this to OAK. We're going to start off with share-based payment expense recognition. Put that down as a title. Then the first paragraph will be the observation. Keep your story short. On 1 January 2011, options were granted to certain staff to vest in 3 years. No expense has been recognized this year, apparently because share price has fallen by 5% in the last 6 months. So what does IFRS 2 say about recognition? It says, share-based payment expense should be recognized when the scheme is legally binding. The fall in share price is a market condition and should be ignored for the purposes of recognizing the share-based payment expense for the year. Next, go on to state the risk. Risk that management still unwilling to recognize the share-based payment expense, and consequently the impact on the financial statements would be that the share-based payment expense and the corresponding entry to equity is also understated. Your next title will be share-based payment expense measurement. You don't have to put down the observation again. Go straight to the accounting standard. So the fair value of the share option should be based on the number of employees expected to exercise the option. The expense should be adjusted each year to account for staff turnover. It may be unrealistic to assume that all executives and senior managers receiving the options will remain in employment till the time when options vest and none resign. The risk is that management assume that all those receiving the options will remain in employment at the end of the vesting period. Consequently, the share-based payment expense and the corresponding credit to equity may be overstated. Then another point under measurement, the share-based payment expense should be calculated based on fair value of the share options at grant date. The expense should be spread over the vesting period with corresponding credit to equity. The risk here is that fair value has not been measured at the grant date but have used another date. Consequently, the expense and corresponding entry to equity may be misstated. Next would be the entry relating to deferred tax consequences. Put that down as a title and go straight to explaining IAS 12 requirements relating to share-based payment expenses. The share-based payment plan should also have a deferred tax consequence as a result of the financial statements recognizing the expense in 2008 and the taxman not allowing the expense as a tax-deductible expense in 2008. As a result, a deferred tax asset should be recognized. Risk is that the deferred tax consequences have been ignored. Consequently, the deferred tax asset is understated. So note that there is no requirement to include the accounting standard number or the title. When writing out the accounting standard requirement, use the words should or should not, must or must not. This makes the required accounting treatment very clear to the marker. There's 1 mark for each accounting treatment and 1 mark for each risk. So that's it for the share-based payment expense in Oak. The next video is on share-based payment expense in Bluebell, which has some slightly different circumstances.